Hello, everyone, and welcome to Trade Finder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. It's always available on our website to be read in full detail at your leisure. It's the main point to take away, though. Is the tariff tantrum over? Interested to hear what Rob has to say about that, so let's get right into it. Rob, you out there?
I am, Zach. How are you? Happy Tuesday afternoon to you. Welcome to Trade Finder, everyone. And that was a good phrase, Zach. Tariff tantrum, I think, is kind of what we experienced Sunday night and Monday morning. I did talk a little bit about this yesterday in our shows for both EWO and Hub. But let me give everybody a quick rundown. We talked about the potential for something happening going all the way back to Thursday night during our insiders meeting for alert subscribers at EWO Trader, where they asked if I was still concerned about something happening to the downside, and I answered yes, and didn't really think that the whole tariff thing would be the trigger, but I was worried about something happening the way the market was setting up. And if we take a look at the charts, you can see we are trading currently right at the 10-day moving average. That's the lime green line on your chart. We traded down below the 50-day moving average yesterday and then recovered as news was coming out kind of fast and furious. I'll go ahead and move back to the daily chart and review a few things. We talked about some of this we did talk about in the U.S. market update on YouTube over the weekend. I really didn't understand what happened on Friday. If you go back to pre-election, Trump was talking about how he would add tariffs and talked about how they would go into effect. And I don't know if the market just thought he wasn't being serious, or I have no idea what was happening. But then on Friday at just somewhere around 1 o'clock, he came out and said, yes, the tariffs will go into effect, 25% on Canada and Mexico, 10% on China, and they'll go into effect on Saturday, which is February 1st, which is exactly what he said he was going to do. And the market went, boom. It just went straight to the downside. It was like they'd never heard that before, like this is some brand new news. But it wasn't. It's exactly what he said. And even the financial networks were saying, I don't understand why the market's reacting this way. This is what he elected. He said he was going to do this. And then when they actually went into effect on Saturday, we had the futures market open up Sunday night. They opened at 6 p.m. Eastern time with the retaliation, not unexpected again, from Canada and Mexico. Canada said that they would announce their tariffs on Tuesday. Mexico said they would talk about their plans on Monday. China was a little less specific on what they were going to do. And down we went again. And we opened up to the downside significantly yesterday. We had a little bit of a bounce and then headed lower. And then it came out to, well, you know what? We'll hold off for a month on the tariffs. And it was all just a negotiating ploy. It's leverage. It's what Trump does. He's a negotiator above anything else that he does in his life. He likes to negotiate deals, period. I mean, that's what he does. And if you think he's anything else, then you just haven't been paying attention. And so we got rallied back to the upside. And then the market for the rest of the day yesterday was like, I don't know, what do we do from here? So we had a little bit of a further dip from the down open, had a big quick rally, and then just went sideways. And then the market opened a bit lower on the pre-market this morning, gained back a little bit. You can see these big bars. It's just the market makers are trying to figure out trades where people are coming back and saying, oh, yeah, I wanted that trade and didn't get it. And so from this morning, we rallied a bit, and this is pretty reminiscent starting this afternoon of what happened Friday afternoon. Yesterday afternoon, where we weren't sure where things were going to go from here, but everything seems to calm down. The market seems to be aware that it was a negotiating tactic. Whether or not it's all about this, I'm sure you've seen on the financial networks that Trump is determined to stop the importation of fentanyl into the U.S. It's a horrible drug. Millions of people literally have died from it, which is pretty amazing to have that many people. And he wants to stop it. And then Mexico said, okay, well, we'll put 10,000 troops, National Guard troops from Mexico on the border to stop fentanyl. You guys stop the importation of arms into our country. And Trump agreed to do that. And it was a negotiation, which is what he wanted. So now we're back to no harm, no foul. All that stuff has settled itself out, and we're back to pretty much where we were before all the madness started. And we'll see where things go from here. I think an indication of where we may go from here comes in lieu of the bond market. So let's switch over to TLT. And while we do that, I'll talk about the economic news that came out. We had the JOLTS report, that's job openings. Basically, were lower than expected, which means the labor market is tightening back up. Again, right now, there are 1.1 jobs open for every one person that's looking for a job. So it's kind of a status quo type of scenario, which is not a bad place to be as far as the employment area. The Federal Reserve is going to wait, I think, before they do any more rate cuts. Again, Chairman Powell said, don't expect anything till maybe the second half of the year as far as rate cuts. We're not going to cut. We're going to watch for a while. And then another Fed governor came out and said that she wanted to see more evidence that we were going down in the we were going to wait on as far as further rates on potential rate cuts from here. She wanted to see inflation data come in a little bit better. The last inflationary data that we had was in line last week, and that was the PCE report that came out on Friday. It was in line with expectations, but the year-over-year number, which is really the one the Fed really wants to look at, is still, quote, sticky. We're hovering around 2.8. The Fed wants to get it down to 2. So probably not going to see any rate cuts in this first half of the year. None of this is anything other than what's been talked about throughout the markets. And this crazy volatility that we've had, although it's not unlike what I talked about in the outlook for 2025, is that I think we're going to have more volatility this year, and it's going to be both to the upside and the downside, not just one way or the other. And yet the market seems to be reacting to all this news like it's something new out of the blue. It's kind of bizarre. But when you look at the TLT right now, we opened up with prices down and yields up a bit, and now prices have risen up. So the bond market has calmed down based on that economic news. Again, nothing too extraordinary occurring. We do have a little bit of an expanding triangle here on TLT, so we're going to get a little bit of a move in rates one way or the other here, probably in the next couple of weeks, but it's not significant. It's not a very large triangle, so we'll see what occurs from here. It's just if you take the cues from look how calm the bond market has been through all the wild stuff that's gone on in the equities market, and the bond market's like, you guys are crazy. What are you doing? It's just been kind of calm in the bond market. And I think you can take some solace from that. And it gives you the idea of not to panic. The other thing is the VIX didn't get very crazy, even as the market was going nuts with the futures, et cetera, Sunday night. We did spike up a little bit above 20, but we didn't stay there. We came back down. At this moment, we're at 17. This is where we closed yesterday at 1862. So the VIX is down a bit. It's closed this gap this morning. So the fact that we didn't spike above this high at 22.5, I think was telling on Sunday night and Monday morning that, the market seems to reacting pretty negatively, but it's not an extreme. There was no big spike in the VIX that was occurring. So it's kind of, all right, let's calm down, reset, and see where we go from here. And I think that's what we need to do in taking a look at the markets. As far as looking at the rest of the charts, they're all going to look the same pretty much. We had this big lower open in the Dow yesterday. It recovered back above the 10-day moving average yesterday. It is today as well. If we look at the Qs, you would have thought, oh, wow, there's going to be some wild action in the Qs. But without significant craziness in the bond market, the Qs were just like, okay. We had a breakout of this descending triangle. We've come back and tested it. We held support at 510, even on yesterday's low, which I think is telling on the Qs that we held 510, and then move back to the upside. If we can close here above the 10-day moving average today, that would be telling for the Qs. If we look at the small caps, not quite the craziness, and you would expect that because they're very sensitive to rates and what's going on in the bond market. Since the bond market has been much calmer than the equities market has been, there hasn't been quite the volatility in the IWM. We're just in this trading range here between 220 and 230. We need to wait and see which way we're going to break. Notice that you can't even tell the difference on where the 10, 30, or 50-day moving averages are. It's all one big blob of colors because they're at the exact same spot. So consolidation is occurring in the IWM. I don't know that you want to do anything in the small cap market until we get a break one way or the other. So we either need to break down here below 220. I'll just go ahead and draw this, move this up here so it's on the big round numbers. The consolidation here that occurred, I call this congestion when you trade through a price level rather than hitting it on the top as resistance or bouncing off the bottom as support. When you're trading through a particular price level, that's congestion. And that's where the middle line is. But the actual trading range here is 230 to 220, with 225 being the midpoint and kind of where we're finding a little bit of short-term resistance and support. So if you're a small cap fan, let it break above 230 or let it break below 220. Other than that, we do have this wave 4. We have a 5-wave pattern that is qualified to the upside. But until we get above 230, I don't think we can feel comfortable that the wave 5 is underway. The algorithm, because the wave 4 is purple, doesn't think we're going to make a new low on the small caps. It thinks that that was the low. And we may go through a complex wave 5 here. And you can see the potential start. Hopefully you're starting to see this stuff on your own without me drawing it. But a potential zigzag here with the low yesterday being at 56%, so right between the 50 and 61.8% level. And then that would yield at least 100% extension. And note that if we do move to a further extended level, remember, a 50 or 61.8% B-wave correction gives you an expectation of 100% extension. If we go to a further extension level, that's 161.8, and that would take us to a new high on the Russell, taking out that wave 3. There's a lot of people that have been saying that they think the small caps are a good place to be in 2025, and that's just typical investment manager rotation. They look for, when the markets are moving, where's the underperformance been? Well, it's been in the small caps because they've been more reactionary to what's gone on in the bond market. As we had this move down in the wave 5 on TLT representing the 20-year, so it's kind of the midpoint between short and long-term maturities. We had this move down in price, up in rates, and the IWM being so sensitive to it moved down a bit further than we had in the other equities markets. So I've been saying this for a couple of weeks now. The IWM is the one market that seems to be in tune with the bond market, where some of the other markets have not been. There's been discombobulation, as I call it, between the equities market and the bond market. But we'll see if we can make this wave 5. But we're a ways from that. As I said, we need to get above 230 first before we start talking about that on the IWM. If we move to energy, and then we'll get to the metals and crypto, we look at UNG. We did have a bid up. I don't know why. Yesterday on natural gas, we're starting to get, we're into the 4th of February now, and the market always looks ahead. So we're kind of looking past the winter time when you would normally see a spike up in natural gas from heating, etc. And we just haven't really had that big bid. But we do have a wave 5 set up here on natural gas as well, with the wave 4 at a pretty solid level here, around 50%. Also came down to the 50-day moving average. Maybe we can start to climb higher. I just don't know what the catalyst would be for natural gas to move higher as we're moving out of wintertime. We had, the craziness where it got extremely cold here in the mountains, but then it snowed in Florida and snowed in New Orleans. Once in a lifetime events, they were calling it, and that couldn't create a significant bid in natural gas. So I don't know what does. So I feel like natural gas is probably going to stay in a trading range. And we've had this calming effect here in oil, where, again, we did go above, and I'm just repeating myself for those of you that have been watching before, but for those of you that are new or maybe watching for the first time, I thought we would peak out around 80 after we broke out of this triangle on oil. We went a little higher than that, but now we're back down below 80. And I do feel like this big trading range makes a lot of sense. But we have a qualified 5-wave pattern here, around 56% as well. So oil and natural gas both have wave 4s that could hold at their current levels. And we could have wave 5s to where both natural gas and oil move higher. I don't know. Again, I don't see what the catalyst would be unless something unexpected happens. In the world of oil, you've heard me say this multiple times. OPEC came out and basically said the exact same thing, that the drill, baby, drill that Trump keeps talking about as far as more domestic production of oil. OPEC said, fine, do what you want, but we're just going to cut production to match whatever your increase is. And I felt like that's going to be the theme. I still feel like there's a good likelihood that we're going to stay in this trading range this year in oil, but we'll see. Now, you have to respect that the fact that the 5-wave pattern is qualified, and maybe something does occur. There could be a black swan event, some sort of global war of some kind that we don't know about already that could further affect what's going on in the energy markets. But for now, they seem to be acting pretty much as expected. If we go to gold and silver, you would think that with the craziness in the equities markets that we'd have a bid in gold, and we do. Now, look at this chart. You can see the breakout. We actually had a strangle on GLD in the volatility portfolio at ewotrader.com, expecting this breakout. We exited here when we hit the 100% extension because that's where we thought we would go, right back to the previous 5. We pulled back. We have gone higher, and you wonder how far can that wave 3 go in gold. The metals market seems to be leaning more towards further rate cuts than the equities market is at this point in time. But I don't know. If you take the Fed at their word, which I've always talked about, the Fed is like a fish out of water. In other words, flip-flopping around all the time based on whatever the current news is. They're going to be data dependent. They're going to watch the reports come out. I don't think anything's going to happen at the March meeting either. Nothing happened at the January meeting, which was expected. But then we go to silver, which I think is where things could get a little bit interesting because they haven't had quite the move. They have broken out of the descending triangle that we had here in SLV. A reminder that a descending triangle does not mean you're going to break to the downside. The triangles are the triangles, and they all mean the same thing. They all mean consolidation and expected breakout. Ascending, symmetrical, or descending, doesn't matter. Either one of them can break either direction. But what we do have to pay attention to is this wave 4 here on SLV today is right at 61.8. That's a pretty strong fib level. And if we break above that, I think you can make a strong case that this wave 5 pattern relabels. But until it does that, maybe we find some resistance here. It's also where the highs were back in December on silver, but they do have further catch up to go if they're going to move back to GLD. So if you're bullish on silver or wanting to be, then you would tie that to silver has been lagging gold, and they usually don't do that for very long. There's usually not separation or divergence for too long. They usually move not necessarily in the exact same pattern, but in similar directions. So perhaps we get a further move higher in SLV, but we're going to have to break this 61.8% level first. And as I said, that should act as some resistance. So maybe we get a little bit of calming here in the silver market. But we'll watch to see. It would be pretty impressive if SLV could move higher from here and break above that fib level. If you haven't heard me before, 61.8, I think is the strongest of all fib levels. It's exactly where we are on SLV. So we'll continue to monitor that and play that out. All right, so let's go to crypto land, which was all over the map along with the futures market on Sunday night. We moved down here. You're going to see these long bars here on all of the crypto markets. And you can see that we had this big move to the downside. We got down to about 92,000 on Bitcoin and then have recovered back up. We're right in the area of 100,000. You'd like to see that Bitcoin get back above 100,000 and back above the 10-day moving average. But you can see that we had this move down. And we just did a crypto show for the Hub Financial channel. So watch for that to be posted in the next day or two. We just did the recording, so give it some time. So give it a day or two to get posted. But talking all things crypto, as we do on the Hub Financial crypto show, there was some interesting data. There was the largest amount of liquidation in Bitcoin in the short history of Bitcoin. $800 billion were sold. So people panicked, but you can see it was immediately bought into. So a lot of people bailed, and they bailed too soon. Some fear set in, and then we've recovered back up. So you want to watch 100,000. You'd like to see it hold here, get back above the 10-day moving average, but we'll see how that plays out. If we look at Ethereum, perhaps you've seen the tweet that Eric Trump sent out, Donald Trump's son, where he said, "This looks like a good time to buy Ethereum. Buy it and you can thank me later." It's on X, or on Trump Social, I should say, where he posted that. And you wonder, should he really be out saying stuff like that? But that's the tweet. A good time to buy Ethereum. You'll thank me later. We'll see if that plays out. But look at the move down that occurred Sunday night in Monday morning in Ethereum, and now we're all the way back up to 2,800, and we went down to under 2,200 on the low. So if you're really quick on the switch, you could have had a really nice move in a short period of time. But we'll see if that was some sort of a head fake, or I don't think Eric Trump has a securities license. Not that they have classified whether or not cryptos are securities or not, but it seems a little odd to send out a comment like that. And maybe he knows something. Maybe something's getting ready to happen in Ethereum. We had this descending triangle. We had the big breakout, although it was really short and sweet. Sometimes it's like that when you break out of these triangles. So what should happen in Ethereum is we should move back at least to the point of the triangle. So we should get back to around 3,200 on Ethereum, and then we'll go from there. We're at 28, so it's another $400 move higher in Ethereum, and then we'll watch and see how that plays out from that point. And then looking at some of the others, Cardano, the crypto guy that we talked to on Hub Financial, not as high on Cardano or XRP, more on Jupiter. We may add that one into the mix in the future here. But again, all the cryptos looking the same. They all reacted, although XRP, not quite as much, but they all reacted pretty much the same way as there was almost panic setting in crypto land. But you could argue that it was pretty close to panic in the area of the equities markets as well. The one thing I did mention, you can go back and look at the recording over the weekend, is something's getting ready to happen in XRP. I talked about this. It was my absolute favorite breakout pattern when you have a vertical move that goes into a symmetrical triangle. My old golf pro days, seems like a lifetime ago, but when you have a vertical move and then you go into one of these triangles. It reminded me of the old ways that flags looked on the greens on the golf course when the flags were triangles. Now they're all rectangles. But I said, this is going to break out. I don't know which way, but XRP is going to break out. And break out it did. And it was to the downside as well. So both Ethereum and XRP, completely different patterns. We had the big descending triangle in Ethereum. We had this, some people call this just plain old flag pattern, but I call it a golf flag pattern, was going to break out, and it did. So we're back above the 50-day moving average here. We'll see where things go from there on XRP. So we're kind of like, take a deep breath, let's reset, and let's get back to talking about what really matters when we start looking at the markets. And we'll go back to the S&P. And you can see that we have turned back up and moved above the 10-day moving average. There was some questions on using Elliott Wave, et cetera, intraday. I just want to reiterate, while I can talk to everyone, that yes, you can use all of the rules that we apply to Elliott Wave, all the rules that we talk about, the corrective pattern, flat zigzag triangles, all those work. It doesn't matter what time frame you're trading. If you're trading end of day charts, great. But if you're more shorter term focused, I don't advocate day trading, but if you are, I know people do it anyway. So yes, all that works. And you can see intraday here on the S&P. Look at that, 55% on the low that occurred right at 1230. We've bounced back off of that. Which means that if this zigzag pattern continues, we should get back up above 600 on the S&P. Doesn't mean it's going to happen today. It could be tomorrow or the next day, or the zigzag pattern could fail. But it's a pretty solid B wave, so it was worth me showing it to you on an intraday basis. And yes, the answer to the question is you can apply all these rules to a shorter term time frame. You know, we're in an age of instant gratification. You know, we've been programmed through YouTube Shorts, TikTok, et cetera. Our attention spans are down to a minute or less. And it seems to be applying to this new regime of people that come into the trading world. But you got to have a bit of an iron stomach to do that, or you get whipsawed in and out. And a lot of people got whipsawed out of Bitcoin and some of the cryptos with this move. And they're probably regretting that at this point in time. So where we are right now is just kind of status quo. The wave 5 did take out the previous wave 3, which is why it was labeled a 5. And we started to come down. And then the question at this point yesterday morning was, are we coming all the way down to this previous 4? We caught ourselves. We recovered the 50-day moving average. We're trying to recover the 10-day moving average today. But we need to see the market break above 610 to look at the wave 5 continuing higher. The 5 could end. And if it does, because the wave 5 didn't extend more than 100%, we would eventually move back down to the previous 4. But we don't know that this wave 5 is over yet. And we can look at the zigzag again. It's my favorite directional pattern. So I hope you all are starting to apply this in your own trading. And look at that. On a daily basis, we have the exact same B wave as we do on the intraday chart of the S&P right now. Isn't that interesting? I think so. But this wave 5 would take us to 625 if that C wave were to extend and the wave 5 extend. We haven't gotten to the bottom part of the tap box yet, which is another reason to think maybe that wave 5 isn't over yet. And so there is some potential for movements higher from here. But if the market is going to react to everything Trump says, my goodness, the volatility could be even more extreme this year than what I thought it was going to be. But for right now, I don't know that I would be too aggressive on entering new positions. If we do break above this level at 610, then I think you could feel pretty confident going long, at least for a period of time. But let's watch and see at the end of the day today if we can hold this 10-day moving average and if we can get any follow through from that tomorrow. That's where we are right now. I know everybody wants to know, well, where are we going to go from here? It's just not as clear at this moment in time where we're going to move from here. But it feels like, that we've calmed down with the negotiating tactics from Trump, and that's all he really wanted was to negotiate. He wanted to negotiate, and he wanted to force the hands of the countries that he wanted something from to bring them to the negotiating table. Seemed to work, and that's all the news that's been coming out. And I just want to make this one comment, just from the general psychology of trading. The market doesn't trade on a longer term basis on news. It trades on a very short term basis on news. So when you have these news events that come out, yes, they can affect the market on a 1 to 3 day basis. But the market has already discounted all this stuff on a bigger scale and is looking 6 to 9 months ahead. Notice here, which I think is interesting, that this tap box for the wave 5 is all the way out to mid-April. So maybe we just need to churn a bit for a while and then have some sort of a drift higher. That would make sense. I've often joked that the market doesn't do what makes sense very often, but that would make sense. But I think maybe we do as much volatility as we've had in the month of January and the start of February. Maybe we get a little bit of, all right, let's settle down and calm down. And then move from there. Let's take a look at some of the international markets. As you can imagine, things have been pretty wild there as well, with global reaction to what's going on here. The big concerns about a, quote, trade war is not good for anyone. And it wasn't, again, that President Trump wanted a trade war. He wanted to negotiate. He wanted to get what he wants. And so on Australia, that wave 4 at 50% is holding. We talked about that in the U.S. market update last week. And so we'll see if we can hold here. We did that on Thursday night during the insiders meeting. We're at the 50-day moving average. You have to respect, again, that wave 4. A 50% correction is a pretty solid corrective number. And the potential for, because this wave 5 down pattern is not only qualified, but it's pretty well constructed. That's really what you want to see in a wave 5 pattern. If resources are going to continue higher, it's hard to imagine the Aussie market going down that far because they are resource rich. And even though the EWA may not be fully tied to gold, that it's tied to other resources like copper, et cetera, iron ore, other things. And it's just hard to imagine this move unless we get a big reversal in those markets. And to get a big reversal in the metals and resources market, we would have to start getting really concerned about inflation again. And, maybe that does happen. But that's the likelihood that we start to get a move lower there in the Aussie market. Now let's look at the EWC. And you can imagine that that was pretty wild. And it has been, as Canada seems to be offended at the commentary, and President Trump again wanting to stop fentanyl. And at first, Trudeau came out and said, "Well, we don't really export that much fentanyl into the U.S." But then there was a seizure of 40 pounds or something of fentanyl at the border. And so it further point, oh, yeah, well, what just happened? And so now they're following along the lines of Mexico saying, okay, we'll shore up the borders for looking for fentanyl coming across the border. And so we've rebounded right back up as there's been a month moratorium on the tariffs to, I think President Trump wants to see if these countries are going to do what they said they're going to do. Are they going to shore up their borders and look for this? So big rebound in Canada. This is kind of what you would have expected to see out of the chart of Canada. And then we have the German market representing across the pond. And they've been pretty concerned about, are they next as far as tariffs? President Trump has said so. I heard some other people, which made me feel a little bit better because I've been commenting about this. I have no idea what's been going on in Germany, why their market has been moving up so much, other than the Eurozone is ahead of us on cutting rates. The European Central Bank has been cutting more than we have, and they're a bit ahead of us. And we had this big breakout. Once again, there's your triangle, the vertical breakout. We've calmed down. We're back above the 10-day moving average here on the EWG, and the wave 3 is still green. Which means that the algorithm is not saying, and then when I talk about the algorithm, it's the Elliott Wave algorithm that this software uses. And if you haven't gone and gotten a copy of the software, go to hub.com, HUBB.com, get a copy of the software. You get free Elliott Wave, you get free intraday Elliott Wave as well. There's an opportunity to subscribe to getting the AI signals if you want those. But it's just an amazing piece of software. It's got a social media aspect, as you're well aware here at TradeFinder. And the fact that this is green means that the algorithm is not sure this wave 3 is done. In other words, we could move even higher on the EWG. And the further we go without President Trump announcing some significant tariffs there, I think that could create a further bid underneath EWG. And then when we go to the market in India, whether you're looking at the Nifty or the INDA, we seem to have found at least a short-term bottom here. It's been really wild to watch the news that's been coming out on India. A lot of investment managers are still coming out saying they're very bullish on India, but then the numbers have shown a lot of money leaving India from investment companies, investment managers. And so there's a little bit of a battle there back and forth between the buyers and the sellers of the market in India. This corrective move that occurred, really classic zigzag pattern to the downside. We've had a little bit of a reprieve, a bounce. Again, the wave 3 is green, so the algorithm not quite sure yet that wave 3 is over. It might be, and until we bounce up a little bit higher to create the potential for a wave 4, we have to think that there could be new lows here on this wave 3, but we'll see how that plays out. I do think that maybe we get a little bit further bounce, perhaps back up to test the 50-day moving average. We were starting to get some separation between the 10 and 50-day moving averages. That works the same way as the rule you hear me talk about all the time. No security in any time frame gets too far from the 10-day moving average. And the same thing occurs when you have separation between the 10 and the 50-day moving averages. So we'll see if that continues to occur. And if we get back to the 50-day moving average, what happens there? Is that far enough to have the algorithm label wave 4? We'll have to wait and see. But I do think, just to summarize India, that this has been a quite healthy correction. We had that big, massive, long run to the upside. Nothing goes in the same direction forever. And having a little bit of a pullback was certainly warranted, I think, on the INDA. All right, so let's go ahead and take a look at a potential case study for this. And I did want to show, because I know this is going to be asked, so I'll save you this, Zach. I'm sure people are going to ask about Palantir, and just use the wrong exchange again. Palantir changed exchanges, so we can give you a better chart here of what's going on. But an unbelievably bullish earnings report last night, and there's your big move to the upside. And Palantir, do you want to chase that now? Well, if you have been listening to me, I don't know if you agree with me. You don't have to agree with me, but I don't like this big, massive gap up. We're way separated from the 10-day moving average. But if you've been long Palantir, you're a happy camper today with that move off of the earnings last night. But now we're way overbought at this point in time. Could we get follow through? We could get another follow through day tomorrow, but I do think there's going to be some rest now in Palantir, some backing and filling. We had talked about, as we climbed up, if we got above 80 and got close to 90, that it would be surprising not to go to 100. Well, we gapped above 100 on today's move. So that big round number is out now. And maybe we come back down towards that over the next few trading days. But I do think some backing and filling is warranted here. I think it would take a pretty significant change in what's going on in the equities market, something to do with interest rates going significantly higher for us to worry about filling this gap anytime soon. Likely, as you know, that the gap will get filled. Our AI data tells us 94% of gaps get filled, but we don't know when. It could be way into the future that the gap gets filled. But I do think we're set up if we get even if we get one more follow through day tomorrow, which we may or may not get, some sideways movement now in Palantir, and do a little bit of backing and filling, at least back to see if that big round 100 number holds, and then we'll have to relook at things and see if it goes from there. Also, with a wave 4 at 33%, you're looking for a 61.8% extension. We exceeded that a little bit. So you can see from a traditional Fibonacci Elliott wave pattern, we're at a potential resistance point, and this big, huge gap up is giving us an opportunity to rest a little bit. So I think maybe we calm down a little bit in Palantir, but kudos to all of you that may have been in that. So the case study that I want to look at today is Apple. And we just have had this, I mean, anything negative that could have come out on Apple has come out. And they came back down. I was wondering yesterday, are we coming back down to 220 again? We didn't quite make it to 220. So that support level held. And now we want to see, are we starting to build a pattern of higher lows? Are we starting to get a little bit of a move back? I mean, what else negative can come out on Apple? They've just been absolutely trashing Apple with all the reports. And this is where you come in when you hear all these analysts making comments. Is it ulterior motives? Are they trying to push Apple down so they can get in? I've always mentioned, and if you've heard me before, you know that I've said this, Apple is the one stock that the stock that I'm most nervous about ever going short on, because they have so much cash and they watch their stock price. And when it gets to the point where they feel like it's undervalued, they do a stock buyback. I don't know where that is. I'm not in their boardroom, so I don't know what levels they necessarily think signifies the fact that they're undervalued. But they make those determinations. So it's always challenging to short this stock because if it starts to go down and you're thinking, okay, I'm doing well in my short position and heading lower, then they announce a stock buyback and you get whipsawed back to the upside. But we'll see if we can continue this. I like the formation of a bit of a 45-degree angle here. We got to get back above that 50-day moving average first, though, to feel more comfortable about Apple. We're just tapping the 10-day moving average on the high right now. Can we get back above that? And the 50-day moving average isn't far from there. So we'll see how Apple plays out throughout the rest of this week and into next week. If we can recover the 50-day moving average, get back to 240, then I think we could make an argument that we may go test these highs. But we're not there yet, just to be clear. But I do like it's more of a speculative idea that we could turn and go higher. If we look at the ADX, it's going to be a mess because the ADX, along with the DMI, is a more of a lagging indicator. So what I like to look at is the CCI for shorter term. That's how it melds into our confirmation indicator system, along with Elliott Wave and the AI. And you can see that we came down here. We broke the zero line. We're trying to break back up to zero. And you could make a case that we have convergence here or agreement between the CCI making these higher lows along with the price seemingly making higher lows. So it's a bit more of a speculative trade. It's not necessarily following all the rules that we follow in any of our portfolios, but the risk to reward is pretty simple here. You stay long Apple unless it breaks 220. That's your stop. If it breaks 220, you're out. But if it can hold that level or continue higher, I think we're in good shape. And then we, feel a little bit more confident if we can get back above the 50-day moving average. But it seems to be a pretty good spot to be, especially the way the bond market has calmed down a bit, to see if it plays some catch up, at least back to 240, and then we can take a look at it from there. So that would be our price target, 240. Zach will come back and show you how to put that in as an idea on the platform, the social media aspect that you guys are all taking advantage of. I see people joining every single day, and I like that. They send me a notification. The Hub group sends me a notification every time somebody signs up or posts something, and I love the activity. I think it's a great community. You guys ask wonderful questions, and speaking of that, Zach, let's go ahead and take a few questions at this point before you come back and show them how to put Apple on as our case study consideration for this week.
Sounds great, Rob. We'll get right into it. We got a question here from Ringo1 on PPTA.
PPTA.
That's correct.
All right, let's take a look. Oops. Perpetua Resources. It's gone through some consolidation, holding the 50-day moving average. This is kind of what we're hoping Apple does with this series of higher lows. The chart looks great. To me, the only negative I can see is that we are in the tap box. And back in early January, we hit the midpoint of the tap box, which is where you would expect things to go. I just want to be clear that if you're not used to Elliott Wave or this software, it doesn't necessarily mean that that's the end of the move. You can move to the top of the tap box. You can break out of it. It can relabel to a wave 3. There's a lot of things that can happen. It's just an area that you would look for an expected move and then perhaps some resistance. And this is exactly what played out here. So we got up to this area in December and January. We pulled back, but each time we've pulled back, we've made a higher low. So this seems like a kind of a buy the dip type story. You can see he's having a good day today. And I would think that there's probably a pretty good likelihood that we head back up to that 13 plus level with the wave 5. If we look at the DMI, it's trying to set up. It's not there yet. The ADX is breaking above the negative directional indicator, but it's got to get above 20. So it's not at that point yet. If we take a look at the CCI, hanging around here, around the 0 point is what you want. And there's a slight pattern here. So there's convergence here, just like I was talking about with Apple, as the CCI is making higher lows as the price is. That's what you want. So it looks pretty interesting. I think you might be on something there. If you're wanting to know where would I get nervous, would be if you were to come down here and break below this area around 11. That's some area that formed resistance in the fall, and a break below 11 would certainly be a concern there. But as long as it stays above there, I think there's a chance this could churn higher. Not one that I've looked at a lot, but good looking chart.
Yeah, that was a nice switch up there. Let's go over to AMD for Lisa.
I was wondering if AMD was going to come up. Gosh, Zach, do you remember the days when we used to joke about who's going to ask about AMD? Because it was asked about every single one. Yeah. And just it was who was going to ask about it. And then we got into AI madness and it kind of went away. But we are at now this is kind of an odd Elliott wave pattern. This would be a difficult Elliott wave pattern because the wave 4 got to the 23.6% level. Elliott wasn't a big fan of that. And then the wave 5 only went 24%. So this stuff here is all, I think, likely to get relabeled because this is just not the norm when you're looking in the Elliott wave algorithm. it looks more like we're doing a lot of nice consolidation here around 120. So I wouldn't pay much attention to this 5. Like I said, this is really odd levels here. Not the norm. This is not what you would consider a well-formed Elliott wave pattern. It's enough to be labeled in the algorithm, but it's, sometimes you have to take a look at it and use some common sense as well. But as far as where to go from here, for me, I think you would want to see it break above 120. And oftentimes when we talk about these levels, I give a conservative and an aggressive estimate. We all have different risk tolerances. You all know what yours are. If you're more conservative, nothing wrong with that. If you're more aggressive, nothing wrong with that. You just need to know where you are and what you're willing to tolerate. And so if you're aggressive, if we hold this 10-day moving average, I think there's a great chance that we come up and test the 50-day moving average, if nothing else. If you're more conservative, you would want it to actually break the 50-day moving average before you went long. But for now, it seems to be trying to consolidate in this area. As far as a stop or when you would get nervous, a break below 110, I think changes the narrative completely. But for now, I think an aggressive move could be up to the 50-day moving average. Conservative would be let it break the 50-day moving average, and we'll see where it can go from there.
Thanks, Rob. Let's follow it up with CELH.
Oh, we haven't looked at that one in a few weeks. CELH, good old Celsius. We didn't want to see that. Last time we looked at that, we talked about this big move to the downside. It was trying really hard to consolidate in this area. You wanted it to stay above 25. You can see it broke below it yesterday. That's no big deal. Everything has a big down day yesterday, but it's following through to the downside today, and that's pretty concerning. So if you're looking for an entry, I don't think you're there yet. This one I would definitely want to see back above 25 and back above the 10-day moving average, and ideally back above the 50-day moving average, which isn't far away. But with the market bouncing today, the fact that it's continuing lower is a little bit concerning. Let's tighten up the chart and see where we see that whole consolidation in the 25 to 30 range. Now we're looking at going back into 2022 with a potential of moving down to 15. If we can't turn this around rather quickly, and I mean within the next couple of trading days, they'll look to, even those that speculated on this consolidation would look to exit, and that could push it down. We're at 23. There's a potential low there, quite a bit lower from here. So if we don't get back above 25 rather quickly, I wouldn't chase this one. I wouldn't even be an aggressive long on this. I think we need to watch this. This is a wait and see how far that wave 3 can go before we look to do anything here. That looks a little precarious.
Yeah, it sounds like proceed with caution is the sentiment there. Well, you called it.
Absolutely.
There's a lot of chatter around PLTR in the chat, so let's see what's going on with
Figured
the Goog.
And they just can't get away from all the regulatory chatter. It's not affecting it today. They're like shaking it off, and when you have a stock that deals with that constantly, at some point, it affects it, and you can see these bounces that we've had through here. It goes through, but then it becomes immune after a while. It's like, what else can you say that you haven't said already about a stock? And you can see it. Google's like, whatever. You guys keep talking about stuff. Again, we're at the 23.6% level. We're at a 36% extension. The only negative I see here is it's trying to go a little bit vertical, but that could be fun for the next couple of days if it continues. But I do think Google is a good place to be for those of you that have been watching for a long time, you know this is my favorite stock to trade Elliott wave patterns on. It's been my number one throughout my trading career, meaning that put more Elliott wave trades on Google than any others. It just seems to follow to a T Elliott wave. So we could continue higher. Once again, all these wave 5 targets are out into April and May, which is interesting, which I think ties into maybe the market just needs to calm down for a few weeks here. But I think Google's a good one. I think you stay long Google. If you see it break below 200, that would be a cause for pause, if you will. And then you would watch this channel right here between 190 and 200. It could go through some more sideways stuff, but it appears to be breaking out. It's not a triangle, but there's other consolidation patterns other than triangles. Triangles are just my favorite, but this was a horizontal consolidation, and it looks to be breaking out. It's lagged a little bit with its peers in all the AI stuff, but I like Google. I think if you're patient, I think today is a very telling day for Google when there was more negative regulatory stuff coming out, and it's completely shaken it off. So I like this one.
Alrighty, a couple quick symbols for you, and then we'll head over to the platform.
Yeah, 2 more real quick.
All right. Let's look at, for Lori, MU.
MU? Wow.
MU.
Good on you, Lori. We haven't looked at Micron in forever. Here we go, back to October. And that's another cool thing about the software is when you pull up charts like this and you draw lines on them, you don't have to save it as a template or do any of those kind of things that you have to do with other software programs. It just automatically remembers it. And when you bring it back up, whatever you've drawn before shows up. So it was back in October when we looked at this. And this one's pretty easy, Lori. We were right on this support area at 90. If we can hold 90, I think you can be long Micron. But a break below 90, you got to get out because we don't know. It could go down to 70, which it never made it down that far. Notice on the wave 5, we got just short of the tap box, and then it bounced. So from a risk to reward standpoint, I like this because your risk isn't very high. You can take an aggressive long here. Your channel to the upside, you're going to have resistance at 110. There's no doubt about that. Clear channel right there, but we're at the bottom end of the channel. So I think you could bounce up here. If you want to be just a little bit more conservative, let it get back above that 10-day moving average first. But if it breaks below 90, you get out. But I like that one from a risk to reward standpoint. So good call.
Alrighty, and the last symbol for this session will be from JJ, and that's going to be on Soun, S-O-U-N.
S-O-U-N. SoundHound. Did that symbol change? Maybe not. I've looked at this in the past, but I didn't remember that symbol. So this is pretty interesting. So we had the big vertical move. I don't like that. What goes vertically up, oftentimes, what is it, Zach?
Often comes vertically back down.
Right, and that's exactly what happened here. And so that was to be expected. But this is really interesting from 2 standpoints. One, the wave 4 is right at the 61.8% level. That's where you would expect it to hold, which it has. And now we're building another little triangle here. It's not huge, but it's there. It's not a high dollar stock, so it doesn't have to be a huge triangle to make a move. So all I can tell you is that it's going to do something, and you look from like 12 to, I'm estimating here, 7. So about a 5-point move is coming in this stock. But even though the 4 is here and it looks like it's moving to a wave 5, just remember triangles trump everything. So you can't say, oh, it's going to break to the upside because the 4 is labeled there. It's a strong fib level. We're going to break to the upside. You don't know that. You have to respect that it could break either direction. So you either put a strangle on this. I don't know what the option liquidity looks like. Or you let it break out and then follow along. It's trying to break to the upside today, but it's not out of the triangle yet. But there is a $5 move coming in this stock. I just don't know which direction it's going to be.
Very well. All right, so we'll head over to the platform and get this idea posted. Or I did want to confirm with you, Rob, is it going to be an idea or a post for this week?
Let's do it. Let's do an idea. I think
Idea?
it's not following all the rules, yeah, and we'll put that in the commentary. Yeah, we'll put some stuff in there on it on why that is.
All right, very well. So we'll head over to the platform. Hopefully, everyone can see my view there now. This is a jumping off point. You can see our growing community, the trending members, trending ideas, and themes. I see we're a little after time, so I won't hold anyone up for longer than the hour they signed up for. We know your time is valuable, especially with these very eventful few days we've had in the markets. So we'll go into the new idea light bulb here to create our official idea. It's going to be on Apple. As you can see, I just click in the symbol search here. I've identified Apple there. Target price of $240. Is that correct?
Correct.
Very well. And what's the time frame we're looking at on that?
Let's follow along with what everything else has been looking like as far as April. So do 3 months.
3 months. All right. So as you can see, we have these fixed intervals of time for you to choose. We're going to go 3 months for this one. We're going to come back and make this look extra pretty here in just a moment, but I am going to go ahead and hit confirm and publish. That way it is posted. It's now available for you to come in and interact with on the platform. And don't mean to sound like a broken record, but for anyone that might be new or joining us for the first time, as we always say each week, whether you agree or disagree, we encourage you to interact, share your feedback, supporting evidence or thoughts behind your feedback. And then again, whether you agree or disagree, opposing opinions is what makes markets. If everyone agreed, then there'd be no trades to be had. So Rob, I'll pass back over to you to give final thoughts. And thank you all for joining us for another insightful week.
Thanks, Zach. Thanks for all the work behind the scenes. Thanks, everybody, for spending an hour of your trading day with us. I hope you found it interesting because the markets are certainly interesting at this point in time. And it'll be quite informative to see if the market does calm down throughout the rest of the week. I think that's kind of what we need at this point in time, is some calm, and look forward to talking to you all again next week to see where things are at that point in time. So with that, enjoy the rest of your afternoon. Have a great week, and look forward to talking again soon. Take care, everybody.